welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Ed from Random Walk Trading. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing the level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just a reminder, this is for educational purposes only. So with that out of the way, Ed, really great to reconnect. It's been a while, like we were talking about before the recording started. I've just given you the presenter role, so if you want to share your screen, we can get that started. Okay, great. I see something coming up. And while that's coming up, just Ed and I have known each other through the Sheridan community for a long time, so it's nice to meet up outside of that and see what each one is doing. And as a really great trader, he's been a good presenter from what I've seen, and I think you'll find him really interesting and a really good guy. So thanks, Ed, again for coming, and turn it over to you.
Okay. Thanks, Tom. Welcome to be back with the groups, but it's been a fun year so far in 2016. But so everyone can see the screen.
Yep.
Okay. Cool. And in the chat box, you can type your questions in there, and I'll peruse it as we kind of go along. Give you some thoughts on what we do and how we're different, all that kind of good stuff. But we have a lot of fun too. But we'll get started here, and we got our own little disclaimer here saying basically what Tom is saying. This is for educational purposes only. Random Walk does not offer any kind of auto trading. So if you get any financial advice, get with your financial advisor or guru. And so off, saying, would you like a portfolio of trades kind of like this? And I did not cut off the risk graph. Everything is above the zero line here, but you have some nice little chunks of profit area at your disposal. So you can have something like that, or maybe we can do something like this, where you actually got built in an automatic cushion of, in this case, this trade had a built-in profit of 175 with zero risk to the trade, but you have some nice profit areas on both the downside and to the upside. So it's like, Ed, this is not possible, is it? Can't do this. And it's like, well, maybe we can. So I'll kind of go into it, and then we got some goodies for you at the end here. So but first, I'll give you a little bit of a background. As you start out, with options, obviously you're trying to learn the basics of vertical, butterfly, calendars. Then you start getting into learning about your deltas and your gammas and your thetas and the effect of vega on trades. If you come from a stock background and you got fundamental analysis that you're looking for stocks that have a good fundamental analysis, and you typically go long or buy the stock. Some will have different technical analysis. Maybe you're using certain indicators to judge whether to get in or get out of a trade. So you might use Fibonacci analysis, price and volume analysis, very popular with the Investors Business Daily gang. They have their Market Smith product, but their newspapers are pretty good and operate strictly on price and volume. Wellness, nutrition has made a difference back in 2013 when I did a presentation. Since that time, I'd say that my memory's probably got sharper. It's kind of weird, but how the role of nutrition in your diet comes into play as far as when you make what I call impulse trades. I don't say thinking straight, but staying more focused and as far as memory. Not that I have a memory issue, but what I found is certain things that when you went back to elementary or middle school or high school, names just pop in my head of people have haven't thought about in a long time, and in the last couple of years, what's happening is not only the first name popping in, but now I can do the last name. So it's definitely helps because as a trader, we're all looking for some kind of edge, whether it be price edge, volatility edge. Using some of your technical, support resistance lines, that type of thing. Mental health. One of the things I've started here in the last couple of years is meditation or transcendental meditation in particular. And there's about 12 or a lot of different ways of meditation and stuff, but that's kind of helped take some of the edge off the highs and lows because as traders, the fear and greed, the fear of loss, the fear of the greed or when you're in a profit zone can greatly affect your emotions, especially if you have a large position on. Your emotions can go, from 0 to 500 sometimes, depending on what the market does. It's been painful here for the last since the Brexit exit with this straight vertical move up almost with hardly any pullbacks. Volatility's pretty much dried up. But what I was going to kind of get into a little bit is just give an analogy of potential versus kinetic energy or trade analogy. So right here is on the left hand side. I apologize. This white on white really doesn't cut it, but it's, for the sake you can recognize this is a put or an iron broken wing butterfly on the downside on the SPX. Simple position. So you put on a position and you basically defend that position as the market moves in your favor or goes against you. You make some kind of adjustment for the sake. But here we're looking particularly on the downside. So what I consider this is a mountain of energy or mountain of profit sitting here. So if S&P ever decides to come back down and revisit the 2100 level, and we get closer to expiration, you can go to Vegas or celebrate with your wife and get a nice meal. What we try to do with our folks is to take what I call kinetic energy. So nothing's, I'm not saying there's a right and wrong. It's just a different way of trading. But what we're doing is taking the market movements, whether it be up or down, is we're looking at the plus or minus one standard deviation and saying, okay, we don't know which way the market's going to go. Now, granted, I just said we look at technicals. And they can be whatever your technicals. And every trader is going to be different. Me, I like just using price and volume, some simple moving averages and some Fibonacci's. If you got, if you like the MACD or whatever, whatever it has, that's fine. The point is that I'm trying to make is that when the market's going, whips around up and down, in this case we're looking at a Russell chart. If the market's moving up or down, it'd be nice to take advantage of that movement of the underlying. Here, like I said, with the Brexit, everything's pretty much going straight up. Money's pouring into U.S. equities. And when the bubble pops, it's going to be good news for the bears. But what we're trying to do is to take advantage of the movement of the underlying and saying, on the upside or downside, is there a trade that we could put on that can give us a nice profit area, or maybe take some risk off the table. So in this case, we have this entire downside for the Russell. Once we hit 1135 down to 1060, we have a nice little profit area that we can take advantage of. And right now on the call side, we have a small little profit area. In this case, it's about a 25 point window opportunity on the upside on the Russell. And what we're trying to do is as the underlying moves down or up, and obviously if volatility goes up, that helps premium selling. So whether you're trying to do what we're doing or you're doing simple butterflies, the more probability, the more volatility that we have in the market, the better the premium you can collect if you're selling any kind of spread, and the cheaper the butterflies you can get on. With the volatility, if the volatility kind of dries up, then you're going to pay more for those butterflies. So let's look at So some of the premises that we have is to have find trades with a good risk reward. 3 to 1, 4 to 1. Okay, Tom. Maybe.
Oh, they're just saying Ed was saying your volume was kind of cutting in and out, but to me it sounds good, and for most people it seems okay.
Okay. So, all right. So the basic premise, like I said, we try to find good trades with good risk reward ratios. Like I said, 3, 4, sometimes 5 to 1, and we would like to execute those trades, whatever they are. And then we'll get into that a little bit. Is to put that trade on for a very small debit or small credit. So if that trade, for example, a broken wing butterfly, if you put it on for a small credit and it just sits there, you're going to be happy because you're just going to collect that 25, 50 cents or whatever you're getting for that credit, and you're not out any money. If you're putting on a whatever position and you're spending a lot of capital, and you got risk on, obviously you have risk in the trade. The question is, where is that risk? And sometimes with a little debit, I'm saying 10 cents, 20 cents, maybe 50 cents max typically. But what we're doing is we're looking at the probabilities within the plus or minus 1 standard deviation. And verticals are the kind of the basic building blocks of the trades, and we'll expand on that here in a little bit. But so the question is, how do we create such trades? And we use a combination of techniques, I guess, if you want to call it that. One is layer spreads, what we call black ops trades, liquid adjustments, and the combination of those three increases the probability of a risk-free trade. Now, obviously, you can't guarantee that because you can only deal with what the option chain is allowing you to sell, or if you want to buy. Like I said, if the volatility's dried up, last week, the VIX hit, $11.77, and it's like, if you're trying to sell something, you're paying through the nose to put that position on. But as the premium or the volatility increases, you can get more premium selling spreads, and you can do more different combinations of verticals that you can combine. So, combining verticals refers to butterflies, condors, unbalanced butterflies, all those type of things. So the layer spreads, the black ops trades, and liquid adjustments are courses that we have, but we also talk about that we have a weekly webinar on Thursday nights, and for the month of June we spent pretty much the entire month talking about black ops, and a lot of our material has specific criteria, step-by-step criteria, saying step 1, step 2, step 3, and then we do the same thing with our Thursday night class, and then the layer spread is basically putting trades on top of one another without increase. You may increase risk, but can you put it on and maximize the amount of capital? Because for example, if you hit the broken wing butterfly on the put side, let's say this is all puts, and that was an example that we showed a little bit earlier. Was let's say it's 5,000 at risk on the downside. You're going to be margined. If you got Reg T, you're going to be margined. For that risk because you got some account you got to kind of pony up. So if it goes against you, the brokerage firm is going to say, hey, you made max loss. We want 5K. What we'd like to do is to kind of look at okay, that was on the put side, but can we do something on the call side? Maybe we don't do 5,000 of risk on the upside, but is there a trade that we can put on that we could increase probabilities or create a profit zone? Because we're taking basically a coin flip of what we think the underlying could do. But the combination of those two is like you power your flux capacitor with those, and you can get some pretty cool scenarios. And we've had a number of students that have had some success of applying that. Liquid adjustments, which I'll briefly talk about, is basically you take any curve of any position that you have, and what we're going to do is take chunks of a butterfly, chunks of a condor, and learn to move it where some risk is, but you're going to learn to manipulate that P&L graph in such a way to maybe you move it to the put side and you eliminate the risk, or you want to take it and you want to move it to the upside. So that's kind of the concept of a liquid adjustment. That we have a whole book dedicated on that. But so our playground is basically, if we go out, if we're staying at the Bellagio in Las Vegas and watching the beautiful little fountains, we got a number of tools in our tool belt, just like your normal option basics and then positions, but we're configuring, using vertical spreads to, like I said, create condors or unbalanced condors or ratios to put on positions that, are within, like we said, the plus or minus one standard deviation. Now, as the volatility picks up, obviously the range, of your plus or minus one standard deviation is going to increase, and as the volatility contracts, the window or range shrinks as well. So that's kind of where we're playing, because that puts us in the best odds, saying that the underlying, and if you're going plus or minus one standard deviation, is 68.2% of the time. If you've got a position in there, you got a pretty good chance of getting inside whatever position that you have inside there. If it's butterfly, condor, or maybe you're playing a directional type play. So that's kind of a little background on our thought process when we look at positions. So what I thought I'd do is to kind of take a look at a recent example, and this is the first risk graph that you saw in the presentation, and this was trade 34, using the July 15th expiration on the SPX. And I'm going to kind of walk through it. And I just got screenshots, and at the end, I'll show you how you can get a copy. I did like a 12-page write-up on this, kind of breaking it down, step by step, what the chart was, what I was thinking, what was going on that day, to get it into perspective. So what I'm trying to, I guess, convey is, if you can take these techniques and apply it to your trades, I don't know about you, if there's no risk to the trade, that's like, the nice little mirage in the desert. But, if you can strive to get to that point, or learn to adjust or re-look at your positions, you can increase your probability of winning. And sometimes, maybe, the underlying doesn't fall underneath your 10. Well, you had no risk. So, that's better than losing, right? Because, if you're going to lose, then, it's going to take that much longer to make up the capital to compensate for the loss in that particular trade. So, I'm going to kind of walk you through this trade 34. And we basically started out with a long 20-point wide SPX put vertical. So I think it's like it had 2070, 2050, but we'll look at the particular strikes. But as you can tell, this has got a pretty good risk reward. We're risking $2,500 to make 75, so this is a 3-to-1 risk reward. The pink line is the plus or minus one standard deviation, and the darker purple area is the plus or minus half standard deviation. And this screenshot is coming from Options Analysis, which is similar to the if you ever used the Platinum product from OptionX back in the days, but it's that on steroids, which we'll talk about in a little bit later. But that's how we kind of started the position. And the time they moved down, we kind of took the other side, and we sold the 2030 2010 put spread for 560 credit. So now you essentially got a free butterfly on with a guaranteed profit of 60 cents, or in this case, $300 profit locked in if we land somewhere underneath the butterfly at expiration. We were at 2080 in this case. So if I think the next shot here is the market continued to go down, and so I bought another 20-point wide put vertical, paid 480 for it. So on a 20-point wide, that's a good 4-to-1 risk reward. And again, here you see the long vertical that we're buying for 480. And then at this time, the market decided it's going to rebound because I'm not good about picking direction. So it kind of bounced, but in this scenario, we actually sold a 2019 80 put spread, selling one leg, kind of inside the first one. So this one, cost me 70 cents, but I got a nice little profit zone, or second profit area if we continue to move down. So that was the next adjustment. So the next thing that we did is we talked about, we're and that in this case here, let me go back a step here. This is all on the downside. And it's like, okay, the market, seems to be creeping up, and this is before Brexit, but here we're looking at the downside. If we can take advantage of it, it falls in there, great. But if it continues to ramp up, what can we do? So as we sold an unbalanced call condor on the upside for credit. I think we put it that on for like $1 credit, I think. But here we got something within the plus or minus half standard deviation. Put it on for a credit, so we still got, we're still above zero. Life is good, but the risk in the trade is, we're about $4,800 worth of risk on the upside. So the next adjustment, and this is over about a couple weeks, is as we kind of ramped up, I took some risk off by making a couple of different vertical adjustments, and now you can see that we only got like $300 risk in the trade, and we still have a profit area on the upside. We got a little profit area on the downside, or two profit areas. Got one butterfly, put butterfly here, and then we got a little put condor underneath that. Now this put condor is at the edge of that one standard deviation line if we ever hit it. This one is a little bit higher probability because we're closer obviously to at the money, but you're within that plus or minus half standard deviation. And the same thing with the call side. And we could have just left this trade alone, but some students are saying, hey, we still got some risk in here. We got $200 of risk, and if you want to leave it like this, this is fine. I mean, but as we're trying to show what the techniques that we're doing. So Teddy's asking, what is the margin? So at this point, there is no margin because you're spending $200 of risk on here. So let's go on to the next one. And this is the Thinkorswim screen, and you can see the different trades that we got here. So we added, I think we added a put broken wing butterfly. So we're kind of combining this position down here because we had that put condor and we had a put butterfly. So I did a put broken wing butterfly for a 30-cent credit. Obviously, doing that, we're adding risk back into the trade. But I took some of that 30 cents and I was able to pull the upside up, and now we have zero risk on the upside. Let's go to the next one. And then I think I sold another, I sold a condor on this, but it'll be in the write-up for this guy. But as you can see, the middle area here is, we got like $500 in profit at this point. And then we got a shot to the downside, and then we also got a shot to the upside as well. But we've injected more risk in the trade, right? Because we got 4,500 risk on the trade below 1975. And I think this is 2140, I think, on the upside. We still have, we've added risk in the trade, but we've increased we kind of just floated the entire risk graph to the upside here in the middle. And then the next trade that we did is, I think we sold another broken wing butterfly and then got the risk off on the downside. And then we're only left with the risk on the upside. Down here, so we've created a nice little profit zone. If the SPX ever decides to get a cold and decides to revisit it, we'll be high-fiving, doing a high five with our fellow traders or spouse. But here it's like, okay, where's the risk? And sometimes, like I said, if the volatility is low, there may not be any good options to get the risk out of the trade. Is this something that we're looking on a I don't say a constant basis, but when we look at trades, and I'll show you some of the things that we use to kind of look at that, but you're basically looking at the option chain and saying, okay, here's the risk. How can I get the risk out of it? And like I said, we can use risk reversals. We can use broken wing butterflies. We can use ratio condors. It's just a different spin of using those vertical spreads or combinations of spreads to look at your trades and say, if I think the market's going to keep going up and pass this particular break even at 2140, I need to do something. So, as we talked about with a liquid trade, we can take a chunk, maybe this put condor or butterfly down here, and use the proceeds of that to take the risk off on the upside. So that's exactly what we did. Is we took some of the profit on the downside, and then that's how we ended up with everything above the T0 curve, or the everything above zero. So that's just, like I said, a very quick overview. But I'll show you how to get a copy of the write-up here at the end, with some of the goodies that we have for you guys. So, any questions on that? I know I went kind of fast on that.
Just that one question from Teddy about the margin, but you already answered that.
Yeah. Yeah, so it's kind of cool. It's like I said, it's a different way of looking at the vertical spreads and saying, okay, it's sort of like having an inventory of wood, and you got to build a house, and all you got is 2x10s. I mean, if you got some 2x10s, I mean, you're gonna have some wicked walls versus 2x4s. But that's how we kind of look at the position and saying, what can we do? And obviously, if the market goes down, implied volatility goes up, and it kind of increases. I'm not saying increases, but it gives you better trade that you can put on without adding a lot of additional risk. So some of the tools, like I said, that we have in our toolbox is the one is the options analysis platform. If you've ever used the Platinum platform, it's that on steroids, because I mentioned it's on steroids because the random walk folks have added their own custom searchers, I guess, for lack of better terms, on the positions that we kind of teach in our materials and stuff. So the broken wing butterflies, risk reversals, iron cockroach. Iron cockroach is basically an iron condor that doesn't have risk on one side of the trade. So you might be, let's say, 20 points on the put side and then 10 points on the call side. And then you can do what they call call instead of stock collars, and some other searchers. But this helps saves time, because we have a lot of students that are professionals, and maybe they work during the day, and they'll use these to kind of give me good risk reversal or a good iron cockroach that they can put on, and then they can kind of tweak it within their brokerage platform. And of course, a complete Excel spreadsheet that he provides to his students. So what this spreadsheet basically does is it gives you the strikes along with the deltas of the calls and puts. We highlight the plus or minus 1 standard deviation for you automatically, as well as a plus or minus half standard deviation. And we give the price for each option. So in this case, we're just looking at the SPX option chain centered at 2150. And then we calculate, what is the expected move on the calls, and then give you what that value is. So this is a 70-point move from where we are. So it's saying, and this is not, I think it was a couple days old, but 2220 by August 5th is what they're saying we can go up to. And then we'll give you the at-the-money implied volatility of the calls, and then we do the same thing on the put side. But what we do is we kind of calculate, what is the price of a $5 wide spread. So the spreadsheet's kind of structured in such a way, this 350 is basically the price of the 2150, 2155 call spread. And then anything in green is basically, when we talked about that risk-reward ratio, 3 to 1, 4 to 1. In this case, I think $1.25. So anything above or less than $1.25 would be considered a good risk reward. So that automatically turns green. So this is all conditional formatting in here in Excel, and you don't have to import anything from TOS. This is all done through macros, and you just type in your expiration up here and your center strike. That's the only two options you have, but it'll automatically pull the option chain and give you the prices of the different verticals. So you can do let's say, $1.50. You can do 2185, 2190 for $1.50, and then this call times 2 means if you skip a strike. So in this, let's see, 216, you go out 2 strikes, that'd be the 2190 and the 2200 price of that vertical, and we go out times 3, times 4 off the option chain. The gray areas are basically taking that and multiplying that spread by 4. We use that in some of the other strategies or techniques that we use to spread off some risk. But it's an actual tool that you can use in real time. So that kind of helps out, giving you an idea of, where's the opportunity to put on a trade, or maybe I want to take off some risk. So that's just a different type of trades. Let's see, get some questions here.
Yeah, I guess it starts. Rich, how many DTE when you open the trade? Those are all the new questions.
Um, it's I don't say yes or no, but I'm gonna use the yes and no, and I hate when people say that. But if you're just starting out, and we have some beginner traders, and we also have some veteran traders as well. I usually recommend going out 4 to 6 weeks if you're new, until you get kind of the feel of it, because when you have more time to expiration, you're gonna have more premium in the options as you get closer to expiration, with under, let's say, even 3 or 4 weeks, the premium or that distribution curve, shrinks up pretty quickly, and you're not going to have as many opportunities, I should say, if you get stuck and you have nothing to sell against it, you can suffer a loss from that. But we usually say, for the new folks, start out, maybe 4, 5, 6 weeks, and that way you can get a feel for applying the different techniques, whether it be black ops or layer spreads, which are the two main drivers, and then the liquid adjustment is how to kind of say wiggle out of a trade, but how can I manipulate that risk graph, like the Demi Moore and Ghost, they're molding the clay. That's kind of how we think about the any kind of risk graph you can pull up on your platform. We say, can we take a chunk off of here and stick it here? And maybe it's off the put side and we're sticking it on the call side, or maybe we're taking off the put side and we're going to add it further down on the put side to eliminate risk. So it's kind of, I don't say unique, but I've not seen anyone do this. But it's, like I said, the combination is pretty interesting. What are the 3x2, 2x3, and 3x4 columns for? So, Rich, what that is let me just take a simple example here. So, yeah, well, I'll just we'll pick 5, 6. Yeah, let me take this spread. So so 2180. Well, let me go to this. Yeah, let's do this 2185. So this 435 is the price of the 2185 and the 2205, because this column is by 4, so you skip 4 strikes. This strike column I have permanently set to 5 strikes, or 5-point strikes. So if the option chain does not, especially some of the further out expiration months may not have some of the 5-point wide strikes, you'll have NA in the sell. But let's just say this 2185, 2205 call vertical is going for 435. In a black ops trade, we're saying, if we need to spread off that risk, what we'd like to look at is we could sell, in a simple case, we could sell 4 of these 1-point wide strikes against it. So I can sell the 2195, 2200 4 times and collect 369. So if I take 369 off the 435, I pay 66 cents for that condor. And then some people will use this and they can do ratio condors. So if I already know what the vertical price is, it's just a matter of matching up the front and back doors, so to speak. Because when you got a condor or butterfly, you're going to have some spread that you're long, and then you're going to sell a spread against it. It doesn't mean you could do 1-to-1. You could do 1-to-2. You could do 2-to-3. You could do 4-to-5. You can play with the strikes. Maybe on your call side, you're only going to use a 5-point wide vertical, but you're going to sell 10-point wide verticals against it. So that's where some of the fun comes in, and especially the volatility ever pops. You can see how these spread prices kind of change, but that's kind of how you use those columns. So hopefully that helps out. And then George is asking, after trade entry, when are you going to achieve delta neutral? Good question. In the risk graphs, the first 2 risk graphs, we'll just take that into consideration. When we add the different butterflies or condors, you have what they call inflection points. So when you got that many positions on it, it's your delta neutral is going to change depending on where you are on that P&L. But in essence, if I'm only looking at the risk in the trade and saying, okay, here's the risk and take it off, if there's no risk in the trade, do you really care what the deltas are? Maybe not. Usually you're using deltas to give you a signal saying this is what I want to adjust, which is fine. I mean, that if you only got, like one butterfly, broken wing butterfly or something on, you may use that for an adjustment point. But when you got, 7, 8, 9 layers into a trade, that could get you a little bit mixed up looking at your Greeks, because as the underlying moves up and down, your Greeks are going to go all over the place. So we're basically just looking constantly of where the risk is in the trade, and then the job is saying how do we eliminate some of that risk. And sometimes we can't. Sometimes we have to cry uncle and say, okay, can't do it with this, but let's see if we can keep some more opportunity in, just in case the trade goes in the opposite direction. So we're always looking left and right, the upside or downside, and saying what's the option chain giving me that I can work with. And maybe it's a small butterfly, maybe it's a small broken wing butterfly. We put it on for a quarter credit or maybe 50-cent credit. Sometimes we do a call condor. We put it on for $1 credit. But when you look at the P&L, you can make 4K, but you're putting it on for a credit. So I know it's kind of dancing around that, but that's when you got that many positions on it, gets a little bit hairy. But it's not that big a concern, because like I said, we're looking at where the risk is in the trade. But it's perfectly acceptable if you got only 1 or 2 positions on an underline. So.
Bode had a quick one. What's your live source of data? I think you mentioned Thinkorswim, right?
Yeah. So when I give you this spreadsheet, you don't have to worry about exporting anything. It talks directly to Thinkorswim, and all these prices update in real time. Matter of fact, you can pull.
That's only if you have Thinkorswim.
Yeah, it's only if you got Thinkorswim. If you got some other brokerage, you'd have to tweak the macros and stuff. Here we're looking at the live shot of everything changing. So we're at 2165 in the SPX. I've got our implied volatilities, but you can see, the different areas in green showing me what spreads are good candidates, and then if I want to, change a different expiration, you can just go. I could do like August 19th. So I kind of delete something then. So now we're looking at the August 19th. And I can scroll up and down. Now the other is some of these are in dark green. So what this is telling me is sometimes when you have a spread, whether it be a put or a call spread that's deep in the money, because when you're putting these positions on your way out there, sometimes these positions can go way in the money. If a 5-point spread is trading at almost 90% max profit, we say, why don't we spread, take the money off the table? Because do you want to have that risk left just to make that extra 20 cents? So that kind of goes into our black ops course. But because even though you may have a 20-point wide spread, that 20-point wide spread is made up of 4 or 5-point wide verticals. So you can kind of just keep chopping away at your max profit as those 5-point wides get closer and closer, versus trying to wait to the last minute. So we're trying to ink out a little bit of more profit into the trade. So that's what those dark green shaded areas are.
We're getting quite a few questions here.
Yeah.
Ron Bertino asked about do you guys have any technical analysis systems in order to time the entries or exits?
I don't. I leave that up to the trader, because every trader's going to have their own little personalities as far as what technical indicators they like. I'm a price volume type of guy, or patterns, cup and handles, double bottoms. I like to use some of those. Sometimes people like to use the TTM squeeze. Sometimes moving averages, the 834 moving average you can use to get in. But many times when we start this is also just, like I said, this one, I call it just a put vertical, because I put it on a Friday afternoon as a single point, 20-point wide vertical on the downside. And, if it goes against me, we have another way of, counteracting that. But we start with the vertical, and then we come in, next week and say, okay, is the market moving? Unfortunately, I think it's the SPX has been a very tight range the last 2 weeks. It's just been insane. But we're only trading what the market's going to give us, so we're really not taking any strong opinion, right or wrong. But if you're putting a position on for a credit and it just sits there, you're not in any money. Usually, what happens is it moves against you, or past a break even, and if you don't get an adjustment in, you can get hurt. But if you're always looking at where that risk is, you can just take it off and live with it. So. Hopefully that helps out.
A couple of people asked the same question about what do you do if the trade goes against you initially, right after you put it on?
So, for example, let me just see if I can pull up. I got two thinkorswims up here, so. So let's do one here. I could do one. Pick September 2nd. So I'll just do a simple example here. So here we're looking at the September 2nd option chain on the SPX, and from a quick visual, I can just go quickly here, and I can say the 2135, 2115 put verticals trading for 485. It's a pretty good risk reward. So let's look at that. Let me turn these off. And 2165, I think. I got the right strikes. No, 2135. Okay. We get 20 points, be 2115. 490. So Excel spreadsheet, it's 490. So good. They should match. So a simple vertical spread on the SPX, and so in this case, if you're doing 10 contracts, it's $5,000 worth of risk. If the trade goes against you, what can you do? So this is September 2nd. What we may do, or many times we'll do, if we think if the market decides it's going to keep rallying to the upside, we would take that 490, and then let's say on Monday we're going to sell the weekly put spread against it. So what we're doing is, let's go here. So next week is 5th. We'll sell the closest, like $1 5-point spread against it. So I'm just going to pick one just for giggles. Since we're out, 30 days expiration. Now the PL graph here will look a little, funny because you got two different expiration months. But let me just uncheck it here for a second. So we're at 2165. So this is 20. Well, yeah, I might so move that down. That's $1.40. Unlock that. There we go. So the market's moving down. So if we paid 480, it's 490. We paid 490 for this long vertical, and that's the September 2nd options. One of the things that we can do is we can sell the front month weekly against it and then collect $1 credit. We're hoping that $1 credit goes out worthless. So if we collect the $1.20, we've done this a couple of times, that if it goes against us, is what we call a Billy Baru trade. It's in our premium selling class. But technically, if you do this 2 or 3 times and these expire worthless, it's going to pay for this 490 and you'll have a free vertical to the downside. So yeah, I spent $5,000 on it, but if I collect, $1.20 on it, now I can reduce my risk by and let me see if I can illustrate this by doing $1.20, and and many times we'll try to let it expire worthless, but maybe you're going to collect, I'll buy it back for 10 cents. And let's lock this in. Yeah, it's not going to. It doesn't show it pretty here, but if you sell for $1.20 on the front month, now granted that's we do it on a Monday, and if it's a front month option, we're looking for whatever the closest dollar credit that we get. Now it's a 5-point wide spread, so we are at risk for $4. But if the market does go down, we still have the long put spread in our favor. So even though this spread, you can get hurt and it jumps on you and it goes down, well, you're short the front week option chain. Well, you got the long put spread that you could do something with that's going to be gaining in value. So the money that you're going to lose on that's going to be picked up in this put spread. So your max profit's going to be reduced. So instead of, and that's why we start with a good risk reward on the trade. So like I said, we got we have 5K risk here to make 15K. So this 15K risk will get reduced if you get bit by this front month. So the strike selection, obviously in your market direction, if you want to sell this and you don't think it's going to go against you, then you can sell it. But could it go against it? Sure thing. We don't know which way the market's going to go. So that's kind of a simple example of what you could do if it goes against you.
Wayne asked if we could get a copy of the slides.
Yeah, I'll give
Just
Tom
send
a
that to
copy
me,
of
and I'll
Tom
attach to the recording.
Yeah.
And then Bryce asked about the spreadsheet, but that sounds like it's something you give your clients or customers.
Yeah, for our membership, and I'll talk about that here in a second, because it is a time saver. Typical time it varies. We've done, some of our veteran guys like the shorter term stuff. Some of the newer folks like the longer term stuff. Like I said, with volatilities being low, you're probably better going out, 4 or 5 weeks. So you have some, you'll have more, strikes that you can play with, because as you get closer to expiration, this plus or minus 1 standard deviation is going to shrink on you.
And Teddy asked, how long does it take to learn this? I guess that's a loaded question.
Depends on how eager you are and how many Red Bulls or Monster drinks you like to have. Like I said, there's 3 different courses rolled into one, but you can see how powerful it is. I think, like I said, that combination of these 3 is can, I think, help any kind of trader with their positions. Does the notation encoding is the ratio of the number of contracts for a fixed distance from the index, where the distance.
I think Ron already answered that a couple questions below.
Okay. Okay. Yep. Yeah. The ratio numbers is still not clear.
Oh, but then Ron explained it, and Rich said, yeah, it's fine.
Yeah. Okay. Gotcha.
I think that's pretty much all the questions. If you want to show that other stuff you had at the end.
Yeah, it's got a couple of slides here. Some giveaways. I say giveaways, but some things that we got for you. So, like I said, one of the objectives is we ask ourselves, what trade or trades can we buy or sell to reduce the risk out of the trade, or increase our profit area? The last question here, talking about, if you buy a long vertical, it goes against you. I refer you to the premium selling, as we call a Billy Baru trade. That's a different course that we have. But the Black Ops is its own book or class. The recordings, we spent the Thursday night webinars that we do, we spent a whole month talking about Black Ops, kind of step by step. Layer spreads is a fairly new book that we just came out with. And then the liquid adjustments is kind of molding that clay and transforming your risk graph. So if I gave you a risk graph and say, take a chunk here and move it over here, you can translate that into a trade or trades to make that happen. So and then if with all combination that like I said, you increase the probability of getting a risk-free trade, which is always good. So, like I mentioned, we have a practical option trading class. It's every Thursday. This is in our Premier membership. We do a market overview. And then we do a technical overview of the major indexes. Like I said, I like to use the moving averages, Fibonacci's, just something really simple, just to where the main indexes are, where the market is. Then we'll review kind of the open trades. We'll have anywhere from 4 to 6 open trades, and then we do a group trade of the week. So the members, say I want to look at NVIDIA or I want to look at Starbucks, and we kind of come up saying, okay, what's a trade that we want to do, and we come up with a trade and kind of actually go through all the different steps, and that may entail, 5 different classes, but it gets you the thought process of what we're trying to do, and then we'll do a different weekly topic on certain trading topic. And we also have a live chat room that we recently started. So it's just a simple little chat room where I actually post things that are going on in the chat room as far as I do a morning update, and I do a mid-morning update. If there's a trade adjustment that I'm looking at, I'm going to give you, kind of the thought process. And sometimes we don't get filled because it doesn't hit a certain trigger or price point. But you're going to get an idea of like, okay, this is what I'm thinking, and then we can add to an existing trade, and then it'll have full access to the options analysis because I put all the open trades are in a folder in options analysis that's part of this package where you get to follow along. So I'll update the paper trades in the actual library, so you get to kind of play with that, and traders can post comments and stuff, or, ask ideas or adjustments. So we just come out with some new membership option packages. We have a Premier Gold and Silver, and the Premier is like I said, Thursday night weekly sessions that we do. The Gold is something new that we're going to start up in September. So we have some beginner people that just has basic option knowledge. But what we're doing is we're cutting the rates for Premier. It's normally $259 a month. For the Capital Discussion members, it's $9 for the first month. If you want the Gold, we got a special for $7. And they're also going to give you guys a discount code or promo code. So Capital 10 in all lowercase will give you an instant 10% off our products or books and videos on our website. And then it's good for until August 15th. And if you sign up, the free package is basically you just get our market updates. I do about 2 or 3 times a week. I'll do a trade of the day concept. I'll pick a stock, apply a strategy, and give you like a 2-minute video on it, and you can get that and watch it at your leisure. But if you want to, there's no strings attached with the silver. It's totally free. But if you sign up for that or any of these packages, everyone will get a free copy of that 13-page write-up on the Trade 34 that we just talked about. So, as a matter of fact, let me put.
Is that spreadsheet included in any of those packages?
The Premier, if you sign up for the Premier package, I can give you the spreadsheet. So.
Okay, great.
And this is the link, and let me jump out of this and put it in the chat.
Yeah, that might be easier.
Yeah, I put that in the chat.
I'll also put that in the recording right up.
Yeah. So that's the link for the different memberships. And with that, if you got any questions, is my email, ed@randomwalktrading.com. You can call the office. We got a couple girls in the office there that answer the phones and stuff. But I'm mainly in the chat room and making updating our paper trades and watching 4 other accounts that I have. So.
Yeah, I know how that goes.
Yeah. So it's and I'm answering emails from students, so it's always fun. So it's a wide range of questions I'm sure you're familiar with. So.
Yep. All right. Well, I don't see any more questions, and I like to end at an hour. Ed Romaine asks, Ed, do you still have your full-time job? It sounds like this is your full-time job now.
Yeah, I gave that up earlier this year, so I'm full-time trading. So. And Rich, the what we're doing with the Gold and Premier memberships is we're including the options analysis features. So the Gold members, I think, get a limited feature set that they can pick. Like I think pick Broken Wing and collars, I think. Don't quote me on that, but the option analysis is part of the package. We kind of mixed it up to make it a little bit easier for people to use the tools. And I think tomorrow night we're having a third session on what we call risk reversals, and I'm going to spend a lot of time with the options analysis tool, kind of walk through the different options and stuff on how to use it, because some folks are completely green, which is fine, but for my benefit, I would give you tips and tricks, and get a search set up, because everyone's busy and kids or whatever, but
Dale says he doesn't see the free silver option on that page that you gave us the link for.
Up at the top, there should be I think for the newsletter. The newsletter is the silver option. Let me just, subscribe to a newsletter. So that's the silver option. So you click on that.
Okay, there we go. Yeah. All right. Well, Ed, many thanks for coming on.
Yep.
I play the violin, and Itzhak Perlman, probably the greatest living violinist, said, anybody can play at a concert anywhere, but it's if they ask you back a second time, then you've done well. So we'll definitely have you back, and we look forward to seeing you again.
All right, no problem. So anything I do, just let me know. So.
All right, sounds great. Well, thanks everyone for joining us, and Ed, many thanks to you and the discount you offered us, and everyone have a great week.
All right, thanks guys.
Thanks.